We're now going to review problem 12-10A on page 591 of your book. So you might have been exposed, and hopefully you were, to the statement of cash flows in a prior accounting course. Accounting 101, you should have looked at the statement of cash flow. So we're just revisiting it again so we can see how a company determines how they spend their cash. Now, this is a formal financial statement of financial accounting. So you can see we use it in financial accounting and also managerial accounting. So what you need to prepare a cash flow statement, as you heard in some of the lecture material, is your income statement and your balance sheet, and probably some additional information made available to you. Now, when we report how a company spends its money or brings in money, we divide activities between operating activities, those generating profit and loss within our income statement, and providing for most of our current assets or current liabilities. Our investing activities, which are our long-term assets, and our financing activities, which are our long-term liabilities, and our equity. Those are the ways we finance the company. So we could divide our balance sheet up and our income statement so we know what section those items will be reported in. So of course, any and most items on our income statement will either be reported on the statement of cash flow in the operating section, except for items that might be gain or losses on investments. So those kind of activities are taken out of the information on our income statement. Also, any non-cash items such as depreciation or amortization must also be taken out of the effect on net income when we're reporting it in the operating area. We also want to report any kind of changes in our current assets or current liabilities in our operating area, because these assets were created by current operations, and these are liabilities that we must pay from our current operations. And we'll start looking at that in a few minutes. Assets that will be reported in our investing area are basically all of the rest of our assets: property, plant, and equipment investments, loans, or just purchases of stocks or bonds of other companies, or sales of them. And then as far as our investing goes, long-term assets such as bonds payable, you could see there, and changes in our stockholders' equity. Now, we're not reporting all changes in these items. We're reporting those that affected cash. So you have to think of it from the perspective of, if cash was involved in that transaction, we got to report it on the statement of cash flow. So, as you heard in the lecture, there's two major ways of completing a statement of cash flows, and we're only going to do one of them, and that's called the indirect method. And that's what 95% of companies use and accountants love, because it's really a much easier method of determining operating cash flow than the direct method. It's not that it's easier, it's just not as involved with computations. Now, the FASB, those financial accounting rule makers out there, want us to use the direct method. And that's discussed in your appendix, and I encourage you to take a look at it. What's the difference between the direct method and the indirect method? How we calculate that very first section, operating cash flow. So let's take a look at this. We have here joiner companies, and we're preparing their statement of cash flows. Remember, what are we reporting on a statement of cash flow? How a company either brings in more money, provides more money, or uses money in each of their major activities in the company: operating, financing, and investing. So as I said before, when it comes to operating activities, we focus on the income statement, the current assets, and the current liabilities. And in an indirect method, What we're seeking to do is convert net income from an accrual basis to a cash basis. So in other words, if this company had used cash basis accounting instead of accrual basis accounting, their net income would have been the $20,000 you see there as cash provided by operating activities. But since they use accrual method, we need to reverse the effect of the accrual method and convert it into a cash method amount. So how do we do that? Well, we start with net income. And within our income statement, on each of those items, sales, cost of goods sold, gross margin, etc., there could be a cash component and a non-cash component. Now, as I said, any amounts that have nothing to do with cash should either be added back if they were subtracted to get to net income, or they should be subtracted if they were added to get to net income. Now, this company, they don't give it to us. They don't come right out and tell us any depreciation, and that's what we're searching for when we're first looking to convert net income to net cash flow. So how do they get that $42,000? Well, we're going to have to do some calculating here. It says, during the year, the company sold equipment that had cost $40,000, on which there was accumulated depreciation of $30,000. So I'm first going to take a look here. Year 2, my property, plant, and equipment goes from, well, I don't even have to worry about that. My year 1, let's do it this way, year 1's accumulated depreciation is $120,000. So you could think of that as being the credit side of the accumulated depreciation account. And you have to think back to regular accounting here, debits and credits. And it says during 2018, the company sold a piece of equipment that had accumulated depreciation of $30,000 on it. So that means when we sold this equipment, we would have subtracted that $30,000 out of accumulated depreciation, leaving us with a balance of $90,000. But as of the end of year 2, our accumulated depreciation has a balance of $132,000. So we increased it by $42,000. So that $42,000 is the amount of depreciation expense in the current year that is reported somewhere on that income statement. So we had to figure that out. We add it back. We subtracted that to get to the $56,000. If we're converting that $56,000 to cash flow, we should have never subtracted it. It has nothing to do with cash. The other thing, and it's at the bottom here actually, and I want to take care of it now. There's a gain on the sale of equipment on our income statement, which increased net income. And it properly should on the income statement. But on a statement of cash flow, that has nothing to do with operating activities. That's cash from investing activities. So we're going to subtract that in the operating section. It should have never been added to get to that $56,000. So those are the two major items that need to be rectified from the income statement. Now, what's your next step? The next step is take a look at all of your current asset changes except for cash, because that's what you're proving here. So, year 1, our accounts receivable had a balance of $170,000. It now has a balance of $250,000. So it increased. People owe us $80,000 more from our sales than they did at the beginning of the year. So that means the effect on cash is decrease. There's less cash from our sales that were included in that $56,000. So when a current asset increases from last year to this year, the effect on cash is a decrease. Although it says increase, we're not saying what happened to accounts receivable. We're saying what's the effect on cash. Same with our inventory. It went from 260,000 up to 310,000. You could look at that as we spent $50,000 more in cash on our inventory. So it's a decrease to cash or decrease on our statement of cash flow. Our prepaid expenses went from 14,000 down to 7,000. So it's like we saved $7,000. So that's an increase in cash. Although it's a decrease in our prepaid expense amounts, it's an actual increase on cash. So we will show it as positive 7,000. Now, we've taken care of the change in current assets. Let's go and look at current liabilities and see how they changed. Accounts payable went from 250,000 up to 310,000. So that means we spent $60,000 less. So that means it increased. So an increase in accounts payable is also an increase in cash. That's less cash we spent. However, accrued liabilities go from 30,000 down to 20,000. So we paid an extra 10,000 of those during the year. So we want to decrease cash for the decrease in accrued liabilities. And income taxes payable went from 42,000 up to 45,000. So you can look at that as a $3,000 cash savings. So that's an increase in cash. So when a current asset increases, the effect on cash is decrease and vice versa. When a current liability increases, the effect on cash is an increase and vice versa. Okay, so we first start with net income, add back any depreciation that was subtracted to get to net income, subtract any gains on investments or add back any losses on investments. We want to wash out their effect on net income. And then we record how cash flow changes because current assets and current liabilities increased or decreased from the beginning of the year to the end of the year. Now add and subtract all those amounts, and the net effect is 36,000. Decrease. So we take net income minus the 36,000. We just converted net income to net cash provided by operating activities. So the company provided $20,000 more in cash during the year from purely operating their business. And that is how we account for the operating activities area. So sometimes you have to sit and think about it, but we only include in this area, we start with income, net income, because that is our first measurement of operations. And then we convert it by using the changes in current assets and current liabilities to account for all operating activities and the effect on cash flow. Now, the next major area we're going to deal with are long-term assets, property, plant, and equipment, loan to Hyman's Company. So they tell us on the bottom that the equipment had a cost of $40,000 and they sold it. They sold it for $18,000. So they come right out and say, we got $18,000. So you put that right there, proceeds from the sale of the equipment. So what kind of money did you bring in or spend on investing activities? Well, we brought in $18,000 from selling that equipment. What else happened? We had a loan. We loaned Hyman's $40,000. Well, the effect on our cash flow is a decrease of $40,000. When you loan somebody money, you're giving them the cash. Now, the final item, which isn't given, which we have to figure out here, is the additions to plant and equipment. Now, it doesn't say we borrowed any money to buy more plant and equipment, but how did they come up with that? Well, you have to do a calculation. Remember, year one, property, plant, and equipment on the balance sheet is at $400,000. They sold piece of equipment that originally cost $40,000. So during the year, they would have decreased that area for $40,000. They ended the end of the year, though, at $510,000. So they went from a $360,000 balance up to a $510,000 balance. So they had to have purchased more items that cost $150,000. And since it doesn't say that they borrowed any of the money, they must have paid cash for it. So you have to make some inferences here. So we're going to decrease our investing activities area for that $150,000 additional investment in property, plants, and equipment. Property, plants, and equipment went up, but the cash went down from that. So if we net those three amounts together, we're going to have a negative impact from investing activities. We spent more than we brought in from this activity. It doesn't mean that's bad. We're just defining. So net cash used in investing activities is $172,000. So far we've defined how we've been spending the cash of the company. For operating activities, we brought 20 grand in. Investing activities, we spent $172,000. Now let's look at financing, how the company gets money. And this will focus on the long-term liability section and stockholders' equity and any cash changes due to those two areas. Without giving us any other information, it looks like our bonds payable went from $70,000 and increased up to $190,000. So that means we borrowed an additional $120,000 in cash. So that's a positive impact on cash from financing activities. Common stock. That went from a balance of $270 up to a balance of $300. It increased by $30,000. So we must have received $30,000 more in cash from selling that. Now, we want to see, how did retained earnings change? Well, retained earnings started with a balance of $83,000. During the year, we would have added net income of $56,000. And if that's all that happened, that would be the balance of retained earnings at the end of year 2, $139,000. But it's not, it's $124,000. So the difference is the amount the company paid out as cash dividends. So we need to calculate that, just like we did with the determining how much more we spent for property, plant, and equipment up in that investing area. So some of these items are right in your face, and some of them you have to calculate, and you have to think about the relationships. What's going into that account and going out of that account that's related to cash? So cash dividends would decrease our financing activities area, and everything else has been accounted for. We've accounted for all the changes and all the other items that would affect cash, whether they be on the balance sheet or the income statement. So net cash provided by financing activities, when we add the 120 and 30 and subtract the 15, will be $135,000. So we brought in from financing activities, provided $135,000. So now we've defined how the company has provided or used their cash for operating, $20,000 positive, investing, $172,000 negative, and positive $135,000 from financing. Net those three together, and the overall change in cash for the year is a decrease of $17,000. Well, let's see if we're right. Cash started the beginning of year 2 at $21,000. If it decreased by $17,000 during the year, then the end of year 2 should have a balance of $4,000 on the balance sheet, and it does. So that is how we prepare a statement of cash flow and the steps we take to complete that process. So I know this is, a more involved area, and you have to really stop and think about it and put your analytical hat on and think about what's happening here. Now, in part 3, they want us to compute the free cash flow for year 2. So the free cash flow would be your net cash flow by operating activities plus your capital expenditures during the year, which were $150,000, plus your dividends. So cash provided by operating activities are $20,000, but you spent $165,000. So free cash flow would be negative $145,000. Now finally, in part 4, they want us to explain why cash declined so much. Well, there's a small amount of cash provided by operating activities. However, most of the cash that was provided was paid out as dividends. A large increase in inventory was offset by a large increase in accounts payable. So that's saying, if we go back up here, inventory might have increased 50,000, but accounts payable did too. So that means we didn't pay for it yet. We didn't use cash to pay for it. The small amount that remained, combined with the cash provided by issuing the bonds and the common stock, was insufficient to purchase a large amount of equipment and make a loan to another company. As a result, the cash on hand declined sharply during the year. What does that mean? Well, we had $20,000 we brought in from operating activities. We were able to finance by selling more bonds and selling more stock, $135,000. But even combined, that's only $155,000. And we spent on investing in new assets $172,000. So that's why our cash decreased overall. And that's what a statement of cash is really used for, to help the company see how and where their cash was either provided for or spent. Okay, so that concludes our practice. If you have any questions, please post them to the discussion board.